Every financial guru on the planet tells you the exact same thing: buy broad index funds. Set your contributions to autopay and just go to sleep. It's the ultimate set it and forget it wealth hack. But what if I told you that by doing exactly what you've been told, you are blindly funneling your hard-earned money into one of the most overcrowded, structurally dangerous trades in financial history? I know, that sounds insane. You're probably already thinking, yeah, right, clickbait. I've been making 10% a year doing exactly this. But stay with me for the next 10 minutes, because I'm going to show you the actual fund flow data that Wall Street prays you never look at. The math is real, the mechanics are documented, and by the end of this video, you'll see exactly why your perfectly diversified portfolio is actually functioning as exit liquidity for institutional whales. Let me show you how this actually works. So here's what got me started down this rabbit hole. I was digging into the granular fund flows of some of the largest ETFs on the market. We've all been sold this very seductive idea. You buy a broad index, you own a tiny piece of the whole economy, healthcare innovators, heavy industrials, energy producers, consumer goods. It feels incredibly safe because it feels spread out. But do you know exactly how much of an S&P 500 index fund is concentrated in its top 10 holdings? Most people intuitively guess maybe 10 or 15%. After all, there are 500 distinct companies in there, right? The reality of the math is terrifying. Today, a handful of familiar tech giants dominate the index to a degree that is historically unprecedented. They completely dwarf the bottom 400 companies combined. You think you're buying the broad distributed growth of the United States economy. In practice, a massive outsized portion of your capital is tied directly to the daily price action of a few Silicon Valley titans, the other 490 plus companies. They are basically just background noise. Here's where it gets really interesting, and for those of you who aren't subscribed yet, my analytics show about 70% of the people watching this video right now aren't. If cutting through financial noise and looking at the actual math is useful to you, hit subscribe. I go after this stuff every week. Okay, back to the plumbing. This illusion of safety comes directly from how modern indices are built. Most are market cap weighted. That means the larger a company's valuation gets, the more mathematical influence it has in the index, and crucially, the more of your fresh capital it automatically sucks up. When your $1,000 hits your Vanguard or Fidelity account on the first of the month, there is absolutely zero human judgment involved. The algorithm executing the trade doesn't care about price to earnings ratios. It doesn't read balance sheets. It doesn't care if a stock is historically overvalued or just riding a hype wave. It acts as a blind, dumb conveyor belt. If the largest companies already dominate the index, the heaviest share of your investment goes directly into their shares, often buying them at incredibly inflated prices, while the remaining pennies get sprinkled across the hundreds of smaller, potentially much cheaper companies. This creates a relentless robotic feedback loop. You pour money into the index, the fund strictly follows its programming, and channels the lion's share of your cash directly to the biggest companies. Because of that relentless buying pressure, those companies' stock prices go up. Because their prices go up, their weight in the index increases. And because their weight increases, an even larger percentage of your next paycheck gets directed to them. It is a self-reinforcing cycle. And it pushes prices completely unmoored from reality. That's exactly why the stock market can hit all-time highs. Even when the underlying economy feels completely stuck in the mud, inflation is biting and corporate earnings are flat. The broader market isn't actually booming. A few dominant players are just being continuously bid up by an endless fire hose of passive, automated 401k money. But every mechanical feedback loop has a dark side. The exact same rigid mechanism that pumps the market up on the way up severely accelerates declines on the way down. When market sentiment eventually shifts, maybe inflation spikes, the Fed panics, or a geopolitical shock hits, people who were happily setting and forgetting suddenly wake up, panic, and hit sell. And this is where the system gets dangerous. Passive selling acts as a heavy magnifier for market crashes. When you sell your ETF, market makers have to step in, break that ETF apart, and sell the underlying stocks on the open market. Because the mega cap tech giants carry the heaviest weights, they take the absolute worst of this indiscriminate selling pressure. Their massive size drags down the entire index. Seeing the index plummet triggers more panic on the news, which triggers more people to sell their ETFs. What was once a steady upward conveyor belt instantly turns into a violent, cascading sell-off. We saw a brief but terrifying preview of this in March 2020. During that panic, certain highly traded ETFs actually began trading at steep discounts to their underlying assets. The machinery of the market literally choked. Desperate investors rushed for the tiny exit door, but the mechanical process of liquidating the underlying stocks couldn't keep up. The liquidity just vanished. And spoiler alert, the market is infinitely more top-heavy and concentrated today than it was back then. Stick with me, because what I'm about to tell you is the part that actually made me a little angry when I finally put the pieces together. Large institutional players, hedge funds, corporate insiders, They understand this plumbing dynamic perfectly. They are not passive. They hold massive concentrated positions in these top companies that they bought years ago at rock bottom prices. Now, they can't just dump all their shares at once. That would crash the price and destroy their own wealth. Instead, they use algorithmic trading to quietly and gradually distribute their shares directly into the steady, predictable stream of passive retail inflows. You, faithfully dollar cost averaging on the 1st and 15th of the month, effectively become the perfect, unquestioning counterparty. You provide consistent demand without ever negotiating the sky-high price. What looks like prudent long-term investing to you functions mechanically as a highly sophisticated system for transferring risk. The early institutional money is cashing out, and the late retail money is blindly holding the bag. I want to quickly address the one counter-argument you'll see in the comments because I know it's coming. Someone is going to say, "Are you telling me to sell everything and try to time the market?" No, absolutely not. The answer isn't to panic, liquidate your portfolio, and buy gold bars. The answer is to actively build true structural resilience into your portfolio so you aren't collateral damage. When the liquidity cascade happens, there are 3 specific steps to do this. And the third one is what most people never do. Step 1, build a real liquidity buffer. I'm talking about holding cash, ultra short-term government bonds, or treasury bills. I know it's not sexy, it won't double your money in a year, but it provides something far more valuable, ultimate optionality. When the broader market is plunging and everyone else is being mechanically forced to sell to meet margin calls, cash gives you the rare ability to act decisively instead of reacting defensively. It is the dry powder that lets you go shopping when assets finally return to reality. Step 2, stop worshiping market cap weighting. If traditional indices automatically lead to dangerous concentration, look into alternative indexing like equal weight ETFs. An equal weight S&P 500 fund takes your money and mechanically distributes it evenly across all 500 companies. It inherently forces you to trim the bloated, overpriced winners and buy the neglected, undervalued losers. It fundamentally alters your risk profile and dramatically reduces your exposure to the top heavy tech bubble. Step 3 is the part nobody tells you. Run an X-ray. Do not blindly rely on marketing buzzwords like balanced, target date, or diversified. Take 20 minutes this weekend to run your portfolio through a free online fund overlap tool. People are genuinely shocked when they discover that the 4 different mutual funds they explicitly bought to diversify actually share the exact same top 10 core tech holdings. What looks like smart diversification on your monthly statement is usually just heavily concentrated fragile exposure in a cheap disguise. What I want you to take away from this video is a framework for how the market actually functions right now. The game has changed. The easy money era that made passive autopilot investing look like pure magic over the last decade is over. Passive investing is deeply flawed, and it is not immune to structural risks. Once you understand exactly how capital flows blindly dictate market prices, you gain a massive analytical edge over the 99% of people who never look under the hood. So here's what I want you to do today. Before your next auto deposit hits, run an overlap tool on your 401k. Deliberately shift some capital away from those redundant, top-heavy funds and allocate it toward assets that actually diversify your fundamental risk. Drop a comment below and tell me what is the most surprising, heavily overlapped stock you found hiding across all your funds. I read every single comment, and your findings genuinely shape what deep dives I do next. The secret to long-term wealth was never just buying blindly. The secret is knowing exactly what you own when the lights go out.